Now on this channel, we've talked a lot about QYLD, but today's video, as per the title, says what you might be missing with QYLD. And we're going to go behind the curtain and explain exactly how QYLD pays people every single month in its forms of distributions per share that you own. We're also going to talk about tax and what people might be missing when it comes down to how QYLD pays people, how they actually make their money, and how you and I, the shareholders, get stuck with the tax bill. How does this all work? That and more discussed in today's video. So if you're ready to get started, don't be dumb, tap the thumb, and let's get right to it. So in full transparency, I own about, like 450 shares of QYLD or something like that. Let's talk about the three types of distributions that QYLD offers, as well as where to find this information at. Now here's QYLD's website. And the goal of this particular ETF is a high income potential based on covered call writing option strategy. They distribute dividends or distributions every single month for the last 7 years. So if you think about this right from their website, that's kind of a brand promise. You invest in this ETF, here's what you can look forward to. Now, if you're not familiar with the covered call writing strategy and exactly that particular working of the QYLD ETF, I recommend you check out my first video on QYLD. I'll link it down in the description. Check that one out first, and then you can come back to this one to learn a little bit more about what's behind the curtain. So let's talk first about the three types of distributions. Now, what they do these covered call writing option strategies. They make money by doing that, and then they pass that money on to you in the form of a distribution. But because it's not like a typical company paying out dividends out of their profit, what they're doing is this option strategy, which is taxed a little bit differently. It is taxed at a 60% long-term, which is otherwise known as a qualified distribution, and 40% short-term, otherwise known as an ordinary dividend. Now right here on the IRS website, I'll link all of these things that I'm talking about also in the description if you want to check it out yourself, but look at this, Form 1099 Div. That is what your brokerage will send you at the end of every year that you can file with your tax person. It says it right here, dividends are the most common type of distribution from a corporation. They're paid out of the earnings and the profits, and dividends can be classified either as ordinary or qualified. Ordinary dividends are taxable as ordinary income. Qualified dividends that meet certain requirements are taxed at a lower capital gain rate. That means that 60% of that, based on the premiums, is kind of a discount on tax, I guess you could say. So that's all great, qualified dividend. But what is an ordinary dividend? What's that other 40% that you're paying? Well, that means your ordinary tax rate. So it's basically how much money you're making from your job and every other income source. Now I'm going to go right here on nerdwallet.com. A lot of people think, let's say your job pays you $100,000 a year. And then people think, oh, I make $100,000, so I have to pay 24% in tax. That's not entirely accurate. Tax works as a waterfall system. Look at this, 10% up to $9,875. So your first $9,875 that you earn is only taxed at 10%. Then the next amount of money up to $40,125 is taxed at 12%. And then up to $85,000, 22%, and so on and so forth. So hopefully that actually helps clarify a little bit of how taxes work in the United States. If it is, tap the like button, show me some love. But wait a minute, QYLD doesn't pay out in ordinary dividends every year. No, it's actually damn near zero. That's what you might be missing with QYLD, especially recently. There's a third type of distribution, and it's the one they've been paying out the most, and it's called a capital dividend, otherwise known as return of capital. So return of capital in the case of QYLD means all the money that they're making from their investments, people like you and I investing into the ETF, they're paying that back to the investors in the form of a distribution. Why? Because remember the brand promise. They paid monthly dividends for the last 7 years, high income potential. They want to stick to that 19 to 22 cents per share per month. In order to do that, they got to pay somehow. So they're going to take the money and basically give it back to you in the form of a dividend. But why? Well, it's because right now in 2021, we're in an extremely bullish market. It's going up to the moon. And when that happens, it's very difficult to make premiums, to make money on covered call options writing strategies. Now, a couple of years ago, that might have been a different case. But with 2021 being so crazy, it's mainly return of capital. In fact, I think it's primarily, and I'll show you exactly how you can find that out month by month on your own. But let's talk really quick about Uncle Sam and tax bills. Here's the beauty of return of capital. You actually don't pay taxes on return of capital. Remember, it's your own money kind of coming back to you in the form of a distribution. And that's kind of cool. What it does do, in the case that, let's say you get $100 of dividends, you own that many shares that 19 cents times whatever equals $100. And instead of reinvesting that dividend back into QYLD, you take this $100 and you use that for whatever you want to do for the next month. What'll happen is your average cost per share of QYLD will actually start coming down, because remember, they're returning your money to you. So how that actually works is your money starts actually going down. Now you can find your average cost per share in your favorite brokerage app, whichever one that you use. They all make it fairly easy to find out what that average cost per share is. But let me give you a quick little example. So let's say, for example, you buy $22.50 per share of QYLD. It doesn't matter how many shares you bought for this example. I'm gonna try to make this as easy as I can. So $22.50 is your average cost. Well, time ticks on. Months go by, years go by, whatever. You're just taking all the money and running with it in these distributions that are all return of capital. Well, now your average price per share over that period of time is now, let's say, down to $21.50 per share. Pretty darn interesting, isn't it? So you didn't have to pay taxes on all that money that's being returned to you. Granted, you still have the same amount of shares. Let's say you bought 100 shares at $22.50. You still own 100 shares. It's just because of the return of capital, your average cost is down. But when you go to sell your 100 shares, you got to be careful. Let's say the year is now 2023 and you decide, I'm done with this. I'm going to sell my 100 shares of QYLD and be done with it. Well, guess what? Let's say the price is going for $23 a share in 2023. Well, because your average share price is only $21.50, there's a difference here, which means that you're going to be paying capital gains tax on the money that you made. So this return of capital can be considered tax deferred. As long as you don't sell, you technically don't have to pay any taxes. But that brings in a very interesting question that you might have, and that is, well, wait a minute. If I just decide I'm going to tax defer this for life, and I'm just going to hold on for dear life forever, and considering you don't buy any more and that you don't reinvest the dividends, years and years and years go by, and let's say your average price drops to $0 a share. Can that actually happen? Technically, yes, it could, in the grand scheme of a long period of time and many, many distributions of return of capital. If you hit $0 per share, a couple things happen. One, of course, if you sell, then you're really going to get hit with an extremely large tax bill, depending on what the current price per share of QYLD is. But once you hit $0 per share, any distribution from that point forward for the rest of your life, as long as you hold on to QYLD, would then actually be taxed at your ordinary tax rate. So if you get to a point where you're at $0 a share, well, at that point, then you're making money. It sounds weird, doesn't it? But that's just something to keep in mind. I don't think too many people have held on that long for $0 a share. If you have, I'd love to hear from you. Comment down below. That'd be kind of a cool thing to talk about. Typically, you're going to probably see around here, $21.50 a share, and so on. So it's kind of cool, though, to think that all those shares that you own, you've paid $0 per share for, if you hold for that long. Oh, I have 500 shares of QYLD and I didn't pay anything for it. You know, it's like, what? And then all of a sudden you sell them all for $23 a share, even $21 a share, heck, even $1 a share. You know, that'd be interesting. But how do we find out what they're actually paying us? Okay, I got 19 cents a share last month. The month before that was 22 cents per share. What is that? Well, here's how you can find that out. If you go to globalxetfs.com, navigate over here to the QYLD website, here's how you find that information out every single month. I hope you guys really appreciate this. Scroll down. The best thing I like to do is just scroll on down here to where it says supplemental tax information. You click on that, and then you can see all the different ETFs they own. You click on QYLD right here. It's going to pop you right down to where you belong. Every single month, they fill out and distribute a Form 19A. So let's look at October 21 as an example. I'm going to click on it. It's going to open up a new tab. I'm going to zoom in a little bit so you can actually see what we're looking at. And this latest distribution of 19 cents per share was 100% return of capital. Remember what I said, we're in a bullish market. It's hard to make money in the covered call options trading strategy. So what is QYLD doing in order to maintain their acceptability of a monthly paying ETF? Well, they're returning your money to you. So that is technically 19 cents per share. Add up how many shares you have, multiply it. That's all return of capital and tax deferred as long as you don't sell QYLD. But it wasn't always that case. In fact, let's go back here. I'm actually going to look at their year-end statement in 2019, Form 8937. I'm going to click on that. We'll zoom in here a little bit, and I'm going to scroll down to where this actually makes sense, right down here. Now, check this out. You have an ex-dividend date, all that kind of stuff, how much they paid out, 21 cents a share, 18 cents a share, 20 cents, blah, 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 all the way down in 2019. Look at their return of capital distribution percentage. Only 14% here, 14%. 3 cents, 2 cents, 3 cents. If we look at January 2019, return of capital was only 3 cents per share. whereas their short-term dividend amount of the total of 21 cents was actually 18 cents in short-term amount, which means that would qualify then as the ordinary dividend. They made money on their options trading strategy, and therefore they're passing it on to you. That's great. That's how this fund is supposed to be structured. You can see back here when the market wasn't so crazy, they could actually make some premiums on this and everything looks fine. Now, before I get to the big question that was asked in the prior video, which is what about the Roth IRA and things like that, let's talk about a warning. And that warning is to my people out there that might be younger or they're just into growth. Let's say you say, hey, I want my portfolio to go to the moon. I want to see some major growth. Well, if you're saying that and you're investing in QYLD, you might want to have a think about that. And here's why I say that. The goal here is this is what we like to call an income fund, making you income every single month. So if you're into that, you want to make a ton of money with dividends every single month, you just throw all your money into that and then you collect the money that gets brought back into you, that's fine, that's great. A lot of dividend investors love to do that. But if that's not you and you want to see some major growth, you want to 10x your money, you want to do all this kind of stuff, you might want to really think about this. Now the QYLD tracks the NASDAQ 100, the 100 largest American companies that trade on the stock market in the NASDAQ, okay? So it's a really cool thing, but there's a better fund. If you're looking for the NASDAQ 100 ETF that shows more growth, you need to look into something like QQQ. That one tracks NASDAQ 100 and isn't focused on options trading strategies and monthly distributions and all that kind of stuff. Sure, you might get some money back in the form of dividends, but you're not gonna get as much as you would with QYLD. But here's the big difference. If we look at Portfolio Visualizer, and let's say we invested $10,000 into each one of these ETFs, QYLD and QQQ, and we started from the beginning of each one of these funds, one-time investment, and we'd reinvest any dividend or distribution they may give us. If we look down here, check out the big difference here. The red line represents QQQ, whereas the blue line represents QYLD. Your $10,000 investment in QQQ has grown to $43,709, representing a 20.96% return. QYLD, $10,000, final balance $18,761, representing only an 8.46%. Last but not least, the big question that everybody was asking, what if I just drop QYLD into a Roth IRA? Because two things could happen. One, if they pay out ordinary dividends or qualified dividends or the return of capital, and I decide to sell it and all this other crap that we talked about on the video, who cares? If it's in a Roth IRA, wouldn't I have to not worry about that at all? And technically you're right. So a Roth IRA, and in fact, if you're not in a Roth IRA already, you need to consider one as one of your first investment vehicles, because here's how it works. Let's say you get a paycheck from your job and they pay taxes for you out of your paycheck. You're left with maybe an extra $100 that you can then invest. Well, you put that $100 into a Roth IRA because it's already been taxed by your employer paycheck, right? So that $100 goes into the Roth IRA. And then as it grows over time, as the stock market grows, as you get distributions, as all kinds of stuff happens, oh, you get all this extra money. And guess what? When you get to retirement age, as you pull money out to live, all of this money in the Roth IRA is tax free. That's pretty darn awesome. So I would recommend that. And if you put a QYLD type of ETF in that Roth IRA, technically, it's not taxed because you've already paid taxes on it. The Roth IRA shields it from the tax. So if you decide to sell it and buy into another investment, or you're just taking the distributions and running with it, and they eventually become an ordinary or a qualified dividend distribution, well, then that's all fine. It wouldn't be taxed once you hit retirement age of 59 and a half or greater. So did that help answer some of those questions? Did you learn something today? If you did, comment down below and let me know. I'd love to hear from you. And make sure you check out this video next on more about QQQ. And then here's the original QYLD. If you still haven't checked that one out, make sure you check this out to go into details about the options writing strategy. And until next time, we'll see you on the next video.